update for September. I'm Gordon Toy and we're joined once again by Bill Keenan, General Manager of Direct Equities, to bring us the latest market developments. Bill, welcome.
Pleasure to be here, Gordon.
Bill, turning first to the US, we've seen some pretty disappointing data in recent months. Should we be worried?
Yeah, there's been a bit of a slowdown in the data in just the last 1 or 2 months. We've seen a manufacturing survey come back down to around 52, the non-manufacturing back to about 51. The payroll data we saw was about 151,000, which isn't too bad, but we're just a bit below expectations. And then the last data point is in inflation in the US has come in a bit below expectations at around 0.8.
So what does this mean for the Fed? Are we expecting a rate hike this year?
Well, the Fed just keeps delaying and delaying, and I think after that recent data that we've seen, they're going to continue to delay. We're now in September, and the last Fed rate hike was back in December last year, so it's a fair period of time. The chances of the Fed increasing rates by the end of this year has dropped to 40%, and with the US election coming up in November, it seems unlikely that they'll be increasing rates around that time. So the odds are definitely coming down from here. And
looking to Australia now, the economy continues to surprise.
Yeah, the Australian economy has been amazing. The last quarterly print we saw of growth came in at 0.5 or 3.3% on the year. So it's an amazing, strong growth there for Australia. It's been 25 years of uninterrupted growth. We haven't had a recession since the recession we had to have, which when I got out of uni around 92. So it's been a very strong run for the Australian economy.
So you might wonder then why the RBA chose to make 2 rate cuts.
Yeah, when you look at the economic growth data, you do wonder why the Reserve Bank cut rates 2 times this year. But it's pretty clear from what the Reserve Bank's saying that they're actually more worried about the global growth outlook. Global growth is slowing. They're worried about inflation. Inflation in Australia has fallen to 1%, and there's very low wage inflation also. And I think they're also trying to keep a lid on the currency, so they need to cut rates to keep the currency down. So for those reasons, the Reserve Bank's been cutting rates. It does, create some risk here that the housing boom may continue and become a bit overextended. But the Reserve Bank does go to pains to say that there has been a regulatory crackdown on the banks, which is true. There's been tighter lending standards and also higher capital requirements for the banks. And they do expect a big supply of apartments to come onto the market over the next 1 or 2 years, which should cool the market down. So they do feel comfortable about the housing market.
And Bill, looking at the local share market, how was profit season?
Well, we've just wrapped up profit season, and I have to say that it's largely come in as expected. What we're seeing is the big companies are generally struggling to grow, but as you move outside the top 20 sort of stocks, there's better growth opportunities there, and the mid-cap, small-cap companies are definitely doing better. When you look at the broader sectors, resources are generally in good shape now, balance sheet wise, but some of the companies are still being caught out with high gearing in terms of Fortescue, Origin and Santos, so they're still not approved on our list, but there has been improvement generally in the resources. The banks are also in good shape in terms of their balance sheets, as I mentioned before, with their capital requirements, but they're just lacking growth at the moment. So they've started to really, range trade at the moment. And the consumer staples in terms of the big Woolworths and Wesfarmers, just showing a little bit of signs of recovery in those businesses, and that we could be in for some better times ahead from those stocks. Other sectors are really quite mixed at this stage as you look across the board.
And what's the outlook for the share market?
Yeah, look, as we move into the Christmas period, it's usually a pretty good period for the market. We're going ex-dividend at the moment, so there's been a few stocks dropping, but we're generally positive based on 2 reasons, is the very low interest rates, as I've mentioned, low cash rate. Bond yield in Australia is only 2%. Cash rate 1.5%, very low. And also the currency is supportive of exporters at around 76 at the moment. The company's cost of capital is very cheap, so the cost of funding is very, very cheap, but they're sort of lacking growth opportunities, so it's hard to find the growth opportunities. Indeed, this globally is happening. So what some companies are doing, they're taking a bet each way, and they're looking for some organic growth or some acquisition growth, but they're also doing buybacks to reduce the number of shares on issue, which increases earnings per share. We expect the market to gradually climb over this period to Christmas. I've said that's a normal natural phenomenon about this time. And I think the key risks are really coming from offshore, not from the US, but from Europe in terms of very low growth, deflation, structural issues. China, a bit of a worry about slowdown there and debt build up in the economy. And lastly, with Japan still battling deflation and low growth in that economy. So that's where the risks sort of lie at the moment.
Well, it looks like there's still a lot of room for movement there in the outlook. We'll wait and see what happens. Bill, thanks for your time.
No worries. Thank you, Gordon.
Thank you for tuning in. You can catch Bill Keenan next month. In the meantime, for better investment outcomes, visit lonsec.com.au.